You've put in the work. Revenue is finally hitting your business bank account. Now comes the big question. How do you actually pay yourself? It sounds simple, but getting this wrong can trigger IRS scrutiny or cause you to overpay taxes. There are income taxes, self-employment taxes, payroll taxes, and in some cases, capital gains taxes. So before you move a single dollar, we need to look at three things. When you pay yourself, how you pay yourself, and how much you pay yourself. And that's exactly what we're going to break down step by step. Because compensation is not just a transfer of money, it's a tax decision. Let's start with timing, because when you pay yourself is just as important as how much you pay yourself. Many business owners pay themselves too early, and that can drain the business of the cash it needs to operate. A significant number of businesses fail, not because they aren't profitable on paper, but because they run out of cash. Profit does not always mean liquidity. Even large companies reinvested heavily for years before prioritizing owner payouts. So here's a disciplined framework. The step 1 is to maintain at least 3 months of operating expenses and cash reserves. This protects you from losing a major client or facing an economic slowdown. The step 2 is to set aside funds for strategic growth, marketing, systems, hiring, expansion, and finally, only after those priorities are covered, you should pay yourself from the excess cash, because healthy cash flow comes first. Owner compensation comes second. Once excess cash exists, there are 2 primary ways to actually pay yourself. The first one is an owner's draw, also called a distribution. This is simply transferring money from the business account to your personal account by check, ACH transfer, or wire. One important point small business owners usually miss is a draw is not a business expense. It does not reduce taxable profit, and it is not taxed at the moment you take it. Instead, it reduces your owner's equity. In simple words, it reduces your claim on the business after liabilities are paid. The second method is paying yourself a salary, specifically W-2 wages. This means formal payroll. Federal and state income taxes are withheld. Social Security and Medicare are withheld, and those taxes are remitted through a payroll system. Which method you use depends entirely on your entity structure. If you are a sole proprietor, a partner, or an LLC not taxed as a corporation, the IRS generally treats you and the business as the same taxpayer. Your income passes through to your personal tax return, and you are considered self-employed. Because of this, you generally cannot pay yourself W-2 wages. You compensate yourself through owner's draws. Now, here is the key concept we hinted at previously. You are taxed on net business profit, not on what you withdraw. If your business earns $100,000 in net profit, and you take 0 draws, you still pay tax on the full $100,000. That profit is typically subject to federal income tax, possibly state income tax, and self-employment tax, which is currently 15.3% on eligible earnings. Now here's a quick reminder. Tax rates, thresholds, and IRS rules change over time. Always verify current guidance, or consult a qualified tax professional before making decisions. Since you are taxed on all net profit anyway, running payroll in this structure usually adds complexity, without creating tax savings. Now, if you elect corporate taxation, the rules change. Let's start with S-corporations. If you operate as an S-Corp, you are legally required to pay yourself a reasonable salary as W-2 wages. Only after that, you can take distributions. Here's why this matters. Your salary is subject to payroll taxes, but distributions taken above that salary are generally not subject to self-employment tax. When you structure it in a proper way, this can reduce your taxes significantly. But there are some rules to consider. There is no fixed amount you will take as W-2 wages for compliance purposes. If your salary is unreasonably low, the IRS can reclassify distributions as wages and assess back taxes and penalties. Also, if distributions exceed your stock basis, the excess may be taxed as capital gains. Now, C corporations. In a C-Corp, the corporation pays corporate income tax on its profits. If profits are distributed as dividends, you pay personal tax again. This is usually called double taxation. However, C corporations can offer expanded benefit planning opportunities, including certain deductible fringe benefits and retirement options. So the key takeaway is that the entity choice is strategic. It decides how the business will be taxed. Now, here comes a new question. How do you determine what salary is reasonable? There is no universal formula. The IRS standard is simple. What would a similar business pay for similar services under similar circumstances? When evaluating compensation, consider your responsibilities, time devoted to the business, industry compensation data, geographic location, business size and profitability, A disciplined approach is to set compensation at a level that could realistically replace you with a qualified professional. If the business cannot support that, the model may not yet be sustainable. Now let's talk about the timing of taxes. The U.S. tax system is pay-as-you-go. If you receive W-2 wages, taxes are withheld automatically. But if you are a sole proprietor, partner, or S-Corp shareholder taking distributions, you generally must make quarterly estimated tax payments if you expect to owe $1,000 or more. Corporations typically must make payments if they expect to owe $500 or more. If you underpay during the year, the IRS may assess an underpayment penalty, even if you pay the full amount in April. To avoid penalties, many taxpayers aim to pay at least 90% of the current year's estimated tax, or 100% of the prior year's tax. Now, when you're ready to pay yourself, execution should be clean and documented. For an owner's draw, simply transfer funds from the business account to your personal account. Record it properly as a distribution. For salary, use a reputable payroll provider like ADP or Gusto. They calculate withholdings, file payroll reports, and ensure compliance with federal and state rules and laws. Informal payroll is where compliance issues begin. Paying yourself is a privilege of ownership, but it is also a compliance decision and a tax strategy decision. Maintaining adequate cash reserves, understanding your entity structure, paying yourself correctly, and planning for taxes throughout the year. That's how you protect your business and compensate yourself responsibly. If this breakdown helped you understand the concept, consider subscribing to TaxClarity US, because we focus on practical, compliance-based tax and bookkeeping education for serious business owners. I'll see you in the next one.